Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets buried in the numbers behind the corporate giants. Today, we're diving deep into the financial statements of Miller Income Fund and a couple of their exchange-traded funds, or ETFs, for the year ending the 30th of September 2025. You know what they say, numbers never lie. So let's see what story they have to tell. This report comes from Advisor Managed Portfolios, a company that manages a bunch of investment vehicles. Think of them like a big umbrella covering several investment funds, each with its own goals and strategies. Today, we're focusing on the Miller Income Fund, which aims to give investors a good income stream alongside potential for growth. We'll also look at two ETFs. The Miller Value Partners Appreciation ETF and the Miller Value Partners Leverage ETF, which are all about growing your money. First up, let's talk about the Miller Income Fund, specifically their class of shares. For a hypothetical $10,000 investment, the costs for the past year were about $134, which works out to 1.25% of that investment. Now, performance-wise, class of shares brought in about 13.92% over the year. That is pretty good, and it beat the ICE BOFA High Yield Master 2 Index, which returned 7.31%. However, it did trail the S&P 500 total return, which saw a bigger jump of 17.60%. The report says the fund did well because it was invested in rate-sensitive areas like financials and utilities. And it even saw a boost from indirect exposure to Bitcoin through companies like Strategy Incorporated, but holding smaller and mid-sized companies known as small cap and mid-cap stocks actually hurt its performance a bit because those big companies, the large cap stocks, did better this year. Looking at the longer term, class of shares gave an average return of 13.07% over 5 years and 8.48% over 10 years without sales charges. The whole Miller Income Fund across all its classes manages over $173 million. It holds about 41 different investments. What did they invest in? Primarily common stocks, making up over 84% of their assets. Corporate bonds and preferred stocks make up the rest, with just a tiny bit in cash. Their biggest bet is on financials at over 22%, followed by industrials and information technology. It is interesting to see they have a significant chunk in financials, which seems to align with their positive commentary on those sectors. Now let's switch gears to Class C shares of the Miller Income Fund. The costs here are a bit higher, costing $210 out of that hypothetical $10,000, or 1.97%. Performance was also a little lower at 13.17%, still beating the high yield index, but trailing the S&P 500. The reasons for performance are basically the same as Class A, all tied to market conditions and specific sector bets. For Class C shares, the longer term returns are 12.23% over 5 years and 7.68% over 10 years. Interestingly, the total net assets for the entire Miller Income Fund remain the same at over $173 million, regardless of the share class we're looking at. And the investment breakdown by security type and top sectors is identical across all the Miller Income Fund classes. Moving on to Class 5 shares of the Miller Income Fund. The costs here are slightly higher than Class A at $139 or 1.30% for that $10,000 investment. Their return for the year was 14%, again outperforming the high yield index, but just shy of the S&P 500. The performance drivers are the same story as the other classes. For Class 5, the average returns are 13% over 5 years and 8.48% over 10 years. Again, the total net assets for the fund are consistent, and so is the security type and sector breakdown. It seems the different classes mainly vary in their cost structure and perhaps some specific service fees. Next, we have Class I shares. These have the lowest costs among the traditional share classes at $103 or 0.96% for our hypothetical $10,000. Their 1 year return is a strong 14.28%. Over 5 years, Class I shares averaged 13.37%. And over 10 years, they returned 8.78%. As expected, the total net assets and investment breakdown remain consistent across these classes within the Miller Income Fund. Finally, for the Miller Income Fund, we have Classes shares. These have the lowest costs at just $96 or 0.90% for a $10,000 investment. Their 1 year return was 14.34%. The 5 year average return is 13.42%. And 10-year returns are 8.87%. Once more, the total fund assets and the investment composition are the same. It is clear that the core strategy of the Miller Income Fund is applied across all its share classes, with differences primarily in fees. Now let's look at an ETF, the Miller Value Partners Appreciation ETF or MVPA. For a $10,000 investment, the costs were really low, just $62 or 0.60% for the year. Performance was also solid with a 7.88% return in the last year, and a strong 22.18% since its inception in January of 2024. The report highlights that indirect exposure to Bitcoin through Strategy Incorporated was a big win. However, a focus on lower price value stocks seemed to drag performance a bit, while growth stocks did better. This ETF manages about $69 million and holds 39 investments. Virtually all of its assets, 99.6%, are in common stocks. The biggest sector focus here is financials, followed by consumer discretionary and industrials. This suggests a strategy heavily weighted towards companies involved in finance, consumer spending, and manufacturing. Lastly, let's talk about the Miller Value Partners Leverage ETF MVPL. The cost for this ETF were $99 or 0.88% on a $10,000 investment. This fund had an impressive 25.59% return on a market price basis, far outperforming the S&P 500. The magic behind this performance is its structure. It nearly always invests in other ETFs that give it 2 times the daily return of the S&P 500, or sometimes just 1 times. Since the market went up most of the year, this leverage strategy paid off handsomely. This ETF is smaller, managing about $20 million and holding just one primary investment type. As expected, it is almost entirely invested in other exchange-traded funds. Its top sectors mirror the appreciation ETF, with financials, consumer discretionary, and industrials leading the way. This makes sense since it is designed to track the S&P 500 through other ETFs that hold these types of companies. Now, let's touch on the auditors. Cohen & Company Limited audited all these funds. For the Miller Income Fund, audit fees were $19,200 for both 2025 and 2024. Tax fees were $3,100 each year for the Appreciation ETF. Audit fees were $14,000 and tax fees were $3,000 for both years. The Leverage ETF had audit fees of $14,000 in 2025 and $15,000 in 2024, with tax fees at $3,000 each year. Importantly, there were no audit-related or other fees, and the percentage of fees for non-audit services was 0, which is a good sign for auditor independence. Let's zoom into the Miller Income Fund's holdings. They have 84.5% in common stocks. You can see Verizon Communications Incorporated making up a portion of their communication services holdings. In consumer discretionary, they have positions in companies like Stellantis NV and the Buckle Incorporated. They also hold Cal-Maine Foods Incorporated in consumer staples and energy companies like Alliance Resource Partners, LP, and Chord Energy Corp. Financials are a big part of the portfolio, with holdings in companies like Western Alliance Bancorp and the Carlyle Group Incorporated. They also have significant investments in consumer finance, with companies like Bread Financial Holdings Incorporated and OneMain Holdings Incorporated. Insurance is also represented with Lincoln National Corporation. In healthcare, they have Semler Scientific Incorporated and Bristol Myers Squibb Company. They also have positions in the Cannabis Company Holdings Incorporated, which appear to be subject to contractual lockup periods. Beatrice Incorporated is another healthcare holding. For industrials, they are invested in United Parcel Service Incorporated, Quad Graphics Incorporated, and Hoeg Autoliners ASAR. In information technology, we see Strategy Incorporated, a company that has gained attention for its indirect exposure to Bitcoin. Materials include LyondellBasell Industries, NV, and Boise Cascade Company. And in real estate, they hold CTO Realty Growth Incorporated. Looking at corporate bonds, the fund holds debt from the communication services sector, consumer discretionary, energy, healthcare, and industrials. For example, they have bonds from Carvana Company, Venture Global LNG Incorporated, and Geld Wen Incorporated. In preferred stocks, the entire 4.1% allocation is in software companies, specifically Strategy Incorporated. Overall, the fund's investments, valued at over $172 million, cost them about $166 million. For the Appreciation ETF, almost everything is in common stocks. They have significant holdings in Alphabet Incorporated, Bumble Incorporated, and Pinterest Incorporated in communication services. Consumer discretionary includes investments in Airbnb Incorporated, Crocs Incorporated, and Lithia Motors Incorporated. They are also invested in energy companies like TechnifMC plc and consumer staples like Maple Bear Incorporated. Financials is a large sector for this ETF too, with holdings in Bread Financial Holdings Incorporated, Federal Home Loan Mortgage Corp, Federal National Mortgage Association, and PayPal Holdings Incorporated. In industrials, they hold Builders First Source Incorporated, Masterbrand Incorporated, and Resido Technologies Incorporated. For information technology, they have positions in Dropbox Incorporated and Strategy Incorporated. And in real estate, they hold CTO Realty Growth Incorporated. They also hold a small position in warrants, specifically Vroom Incorporated warrants. The leverage ETF's portfolio is very straightforward. It is almost entirely invested in one type of security, exchange-traded funds, making up 99.9% of its assets. Specifically, it invests in the Direction Daily S&P 500 Bull 2X Shares ETF. As noted, this fund's performance is heavily tied to this underlying ETF. Looking at the statements of assets and liabilities for the end of September 2025, the Miller Income Fund has over $174 million in total assets. The Appreciation ETF has about $69 million, and the Leverage ETF has around $20 million. The net assets for the Miller Income Fund are over $173 million. The Appreciation ETF has over $69 million, and the Leverage ETF has about $20 million. In the statements of operations for the year ended the 30th of September 2025, the Miller Income Fund reported investment income of over $9.7 million. Expenses were around $1.9 million, resulting in net investment income of over $7.9 million. The fund also had a significant net realized and unrealized gain of over $14.5 million. For the Appreciation ETF, investment income was about $811,000, and expenses were around $403,000, giving a net investment income of over $408,000. They also showed a net realized and unrealized gain of over $3.5 million. The Leverage ETF had a small net investment loss of $969, but a substantial net realized and unrealized gain of over $3.4 million. Let's dive into the financial highlights for the Miller Income Fund. Class of shares for the year ending the 30th of September 2025. The net asset value per S-share was $8.96. The total return for the year was 13.92%. The ratio of expenses to average net assets after reimbursement was 1.25%. For Class C shares, the net asset value per S-share was $9.02, with a total return of 13.17% for the year. The expense ratio after reimbursement was 1.97%. This higher expense ratio compared to Class A is a key takeaway for investors. Considering this class, Class 5 shares ended the year with a net asset value of $8.96 per S-share, a total return of 14.00%, and an expense ratio of 1.30% after reimbursement. Class I shares had a net asset value of $8.91 per S-share, a total return of 14.28%, and a lower expense ratio of 0.96% after reimbursement. This class offers a more cost-effective option for eligible investors. Finally, Class C shares closed at $8.88 per S-share, with a total return of 14.34% and the lowest expense ratio at 0.90% after reimbursement. This class appears to be the most cost-efficient for those who qualify. For the Miller Value Partners Appreciation ETF, the net asset value per S-share at the end of the period was $34.6. The total return for the year was 7.88%. The expense ratio is quite competitive at 0.60%. And for the Miller Value Partners Leverage ETF, the net asset value per S-share reached $36.51. The total return was an impressive 25.59%, with an expense ratio of 0.88%. Now, jumping into the notes to the financial statements, some key details emerge. The trust which oversees these funds was set up in Delaware in early 2023. Miller Value Partners LLC is the investment manager. The income fund is the successor to a previous fund called the Miller Income Fund, and this reorganization happened tax-free. The ETFs, by the way, are listed on the N-CSR. Under accounting policies, investments are valued based on market prices. For Level 1 investments, it is quoted prices in active markets. Level 2 uses observable inputs like interest rates, and Level 3 involves more subjective inputs. For the income fund, most of its common stocks are Level 1, while corporate bonds are Level 2. The Appreciation ETF primarily holds Level 1 common stocks. The Leverage ETF's investments are also valued at Level 1. Importantly, the report notes that due to Russia's invasion of Ukraine, any Russian-based securities held have been valued at zero due to the lack of an orderly market. The income fund has a tiered management fee starting at 0.700% for the first $2.5 billion in assets, going down to 0.650% for assets over $7.5 billion. The advisor has also agreed to cap certain operating expenses, which is a good thing for investors as it limits overall costs. For the Appreciation and Leverage ETFs, the advisor pays virtually all expenses except for specific items like taxes and brokerage commissions. Looking at investment purchases and sales for the year ending the 30th of September 2025, the income fund made purchases of over $74 million and sales of over $76 million. The appreciation ETF had purchases of around $44 million and sales of about $42 million. The leverage ETF saw purchases of over $65 million and sales of nearly $66.5 million. The ETFs also engage in-kind transactions for creations and redemptions, which are essentially exchanging portfolios of securities for ETF shares and vice versa. Class A shares of the income fund have an initial sales charge of up to 5.75%. Class C shares have a contingent deferred sales charge, or CDSC, that applies if you sell within the first 12 months. Class A shares also have a CDSC if sold within 18 months. Distributions for the year ended the 30th of September 2025 were substantial, with the income fund distributing over $7.9 million across its classes, and the ETFs also distributing significant amounts from ordinary income. On the tax front, the income fund has accumulated losses for tax purposes. The appreciation ETF and leverage ETF both show accumulated earnings. The report also details capital loss carryforwards, which can help reduce future taxable income for the funds. Interestingly, JP Morgan Securities LLC held about 43% of the outstanding shares of the income fund as of the 30th of September 2025, which is a significant stake. The income fund has access to a line of credit up to $15 million, which they used, with borrowings reaching up to $4.6 million on a single day. The average interest rate on this line of credit was around 6.98%. The appreciation ETF also has a line of credit up to $2.5 million. The leverage ETF strategy relies heavily on investing in other ETFs, primarily the Direction Daily S&P 500 Bull 2X shares. This means its performance is directly tied to its holdings in this leveraged ETF. P Item 16, Controls and Procedures. Twendu Pin. Finally, the company states that its principal executive officer and principal financial officer reviewed the company's disclosure controls and procedures and found them to be effective. They also confirmed that there were no changes in the internal control over financial reporting that would materially affect the company. So, what is the story here? The Miller Income Fund, across its various classes, seems to be navigating a moderate growth environment, offering income and some growth potential, though it lagged the broader market in its one-year performance. The ETFs, particularly the leverage ETF, capitalized on a strong market year, showing impressive returns thanks to their strategy. However, the leverage ETF's reliance on other leverage ETFs does introduce a higher degree of risk, especially in volatile markets. Investors in the income fund should pay close attention to the expense ratios of different share classes, as they can significantly impact long-term returns. The presence of JP Morgan Securities LLC as a major shareholder in the income fund is also a noteworthy point, suggesting significant institutional interest. What is your take on these filings and the performance of these funds? Do the strategies employed by the leverage ETF make sense to you, or is it too risky? Let me know your thoughts in the comments below. If you found this breakdown valuable, hit that like button to help us out and subscribe for more in-depth corporate financial analyses. And don't forget to join our Discord community, linked in the description, for more real-time discussions and to connect with fellow financial sleuths. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.